Opendoor is setting up for an exciting week, folks. We got earnings on deck for Tuesday. We got Nasdaq compliance regained, a reverse stock split that got canceled, and a key economic data point that dropped on Friday that's very bullish for the company. I'll be breaking down everything you need to be paying attention to as it relates to Opendoor as we head into earnings week. Also, we'll cover the market jitters that we saw on Friday related to tariff news, and President Trump fired somebody else. We'll be breaking down all that and much more here on this week's market prep video. As always, make sure to like, subscribe, and follow wherever you listen to podcasts. And now, folks, let's roll. So the markets on Friday had some jitters, folks. We had a lot of the major ETFs in the market down big off of some tariff news, off of some economic data that came out, and it's really expected after a historic run-up that we've had since the end of April. But one company in particular that defied all the pessimism the market had to throw at it was Opendoor. Welcome back to Stonkcast, the market show for the average Joe, whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor. We've got you covered. Quick shout out, our last video on Opendoor was our most viewed video we've ever had, so a sincere thank you for that. Hope you join thousands of others that have been watching our videos if you are new, and also make sure to subscribe and hit the bell so you can stay up to date on the latest news. And now, with that being said, we're going to lead off this episode with Opendoor versus the macro side. We'll get to that later, but Opendoor right now is one of the hottest stories in the market, and so it makes sense to jump into that. So without further ado, let's take a quick peek here at Opendoor. This is the daily chart, and one of the levels that I've been paying attention to, really a few levels. So the first one would be $2.21. That is the 61.8% retracement level. These are Fibonacci extension levels based off of the all-time low that we had of 51 cents back in June. And then you have the $4.97 high that we had on that explosive Monday a couple weeks back. And so based off that, you get some levels here where stocks typically retrace to. A 61.8% retracement is a pretty deep retracement, but it is an area where the stock could bounce. And as you can tell, we did consolidate between that level of 221 and really 274 for about 3-4 days. And then unfortunately, we did break below it. And really, if you look at last week in general, Monday through Thursday, we just had a lot of selling pressure. And I'll get into part of the reason why that may be. But then on Friday, we did get a nice bounce, which is a positive sign. We did slightly break below $2, a key psychological level on Thursday, but then we regained it nicely on Friday. And we even tested that 221, which is now short-term resistance. Support becomes resistance and vice versa. So as you can tell, back on July 23rd, basically that 221 level was support and now it's resistance. And really what we're looking to see this week as we head into earnings is if Opendoor can get above that mark. So couple things to really focus on here, right? So the options chain, I've been talking about it for a while. Basically, the fact that we've been seeing such a bullish options chain, despite the fact that we've had, a lot of selling pressure, right? Since we've almost hit that $5 mark a couple weeks ago, is very interesting to me. And also take note of the fact that where our volume is at. So you're not going to maintain 1.8 billion in volume. That's just not realistic. However, basically what we've been seeing is that the volume has been dissipating. But on Friday, we saw an uptick in that volume. And up here in the left-hand corner, you can tell the 90-day average volume, we exceeded that by 139% on Friday. So it tells me that we are still getting that retail interest in the company. The volume is starting to pick back up, at least as of Friday. You probably have a lot of people positioning, speculating, right, as we get closer to that earnings report. So that's what we have as far as some of the levels that I'm paying attention to. Again, the $2 level is massive, folks. That is huge. That is a level that we definitely want to see the stock continue to hold up. And, basically, as long as we're above 2, I've been saying this whole time, I'm still bullish on it in the short term. if we can hold above $2. Now, in pre-market on Friday, we got as low as $1.66. Really, a lot of the selling pressure that we saw on Thursday in particular, I think is kind of the aftermath of Jerome Powell not necessarily being dovish as it relates to a September rate cut, and just simply saying we still need to see some of the data. So the fact that he didn't really say anything alluding to a rate cut, at least at first, right, is part of the reason I believe why we saw this continued selling pressure in a company that is heavily reliant upon rates in general because of the fact that it's in the real estate industry. So we hit $1.66 in pre-market on Friday, and then out of the blue, we saw a good jump in pre-market volume and a run up all the way to 215 from a low of 166. And I think part of the reason we saw that run up was due to the fact that we got some poor economic data that came out on Friday, which we'll get into. But essentially, we had some poor jobs numbers that came out. And because of that, the odds of a September rate cut jumped dramatically on the CME Group website. You can check it for yourself. We're currently sitting at above 80% now for a rate cut coming in September. Prior to this data coming out, we were basically sitting at about a coin flip, 50-50 shot, right? And so we were able to hold that as we entered into regular trading hours. We saw a dip down to $1.85 and then a push back up again to that resistance level of 221. And then the interesting thing to me, as we headed into after hours, we saw continued bullish momentum as we, again, are testing that 221 level. So the fact that we got follow through in after hours on Friday tells me this wasn't a one-off day where we were up, 14% in regular trading hours, but that there is strong conviction amongst the bulls that good things are coming. So let's take a quick peek at the options chain from Friday. You got a put to call ratio at 0.33, meaning just about 3 times more calls are being bought, at least on Friday, versus puts. A very, very bullish options chain. Again, we don't know if that's necessarily retail or institutional buyers. Nevertheless, it's very bullish. And right now, the current IV percentile for the options chain on Opendoor looks pretty healthy. It's currently sitting at 53%, meaning 53% of the time in the past year, the IV has been lower. So we're in a sweet spot right now versus a couple weeks ago where 100% of the time the implied volatility was lower than it currently was. So we've seen implied volatility cool off a bit. If anyone's been holding options since last week like I have, you've probably seen those premiums get beaten up because of this implied volatility kind of tapering off. But it does make the options chain a bit more attractive now. And I think that's part of the reason why we are, essentially seeing such a strong put to call ratio for Opendoor. So as far as some of the key strike prices that I've been looking at and noticing, if we take a look at the next monthly expiration, which is going to be August 15th, and we take a look at some of the open interest, you got over 56,000 calls of open interest at the $3 strike. You got 34,000 at $3.50, 44,000 sitting at $5, 47,000 sitting at the $6 strike. There is a ton of open interest on Opendoor right now for some of these further out of the money strikes. So this is a great way to get a gauge on where the market is at, where investors, retail, where everyone's at as it relates to, their speculation about where Opendoor could be headed. So that's the August 15th expiration. And as far as August 8th, right, this week, and the reason I'm looking at this is because we have earnings on Tuesday. Take a look at some of the open interest here as well. Not as crazy as the monthly. Typically, you see more volume on the monthly expirations. Nevertheless, though, you got over 30,000 sitting at $2.50, over 22,000 at $3, and then you got 12,000 at $4. So there's basically a ton of volume on the call side, regardless of what expiration you're looking at. And again, that's reflected at when you're looking at the put to call ratio for the company right now. So part of the reason why we saw such bullish action on Opendoor this past week is because of some of the news that dropped. And so I want to make sure to cover that. So first of all, this from TipRank's website, Opendoor regains Nasdaq compliance, cancels stockholder meeting. So basically, Opendoor was in a position where they were looking at doing a reverse stock split so they could remain compliant on the Nasdaq listing. In order to remain on the Nasdaq listing, you have to have a share price that is greater than $1, right? And so obviously Opendoor now has been above $1 for quite some time, right? Over a week, almost 2 weeks. And so they regained that compliance, which is something that, any investor paying attention to the stock price lately saw that coming, but we got the official notice of it from Nasdaq itself, which is big, right? So that was the piece of news. I think a lot of people involved in Opendoor, we were expecting that, right? The thing that I don't think anybody necessarily expected to drop on Friday was the fact that they canceled the stockholder meeting to vote on the reverse stock split. I think this is massive news. Originally, it was scheduled to happen last Monday, and then we got the news that they were postponing it to August, the end of August, right? We talked about that in our last episode about how that really was a sign of confidence in the entire investing community, retail community, right? Anybody who's involved in Opendoor. And then on Friday, they decided they're going to cancel it completely. So this is new news about Opendoor, the fact that they canceled it, and just further confirms the fact that they believe they don't need to artificially push up their stock price by doing a reverse stock split. Instead, they believe that they can organically grow the share value for investors. So this is massive, massive news that this dropped. And the fact that they did this, right, that these two bullish headlines came out for Opendoor just days before earnings, definitely feels a bit strategic, at least the part about the canceled, stockholder meeting. So, if I was in the position of being on the board for Opendoor and I knew that I had, good earnings coming up or promising earnings at least, this would be a strategic nod, right, to investors and really just bulls in general as it relates to Opendoor. So very, very interesting indeed. And if you are involved in Opendoor, you should be very happy that the company dropped that. So as I said, we got earnings coming up this week on Tuesday. A quick check-in here via Market Beat as far as what the expectations are, right? So for Opendoor, the consensus earnings per share is minus a penny, right? That's what is expected. That's the consensus. As far as expected revenue, the estimate right now, at least according to Market Beat, is 1.50 billion. So we will see when they report, which again is on Tuesday after market close, if they are in fact, going to be close to these numbers, if they're going to beat Wall Street's expectations. That would of course be very bullish for the company. Really what we're looking at right now is just signs of life. We're looking to see that the company is starting to lose less money. We're looking to see potentially, as Eric Jackson has alluded to, the first positive EBITDA that the company has put out in over 3 years. And the fact that we are starting to get some tailwinds on the macro front from, a Fed rate decision in September that's looking more likely to be a 25 basis point cut is just, again, further tailwinds for this company, and a good earnings report would just be icing on the cake. So that's what we got Tuesday, August 5th. And then the conference call will be at 5 p.m. So definitely have that scheduled. Make sure you have an alert set for that if you want to be paying attention to that. I know I will as an Opendoor investor myself, but this is going to be, I believe, a very exciting week. I'm very excited to not only see the report, but also to hear what management has to say about guidance for the rest of the year and heading into 2026, right? To see what their plans are. Because keep in mind, right, Opendoor is in a legacy industry. Real estate, the way things have operated there, is a very archaic industry, right? You got to deal with real estate agents, a lot of paperwork. It's really taxing on people when it comes to buying and selling homes. Opendoor is trying to step into this environment with technology. They're trying to basically position buyers and sellers in a way where they can get cash same day. Who doesn't love that if you're trying to, sell a house, right? So the fact that they are trying to bring technology into a legacy industry like this, I think is massive. You also have to keep in mind the fact that Opendoor, when it comes to the market, right? When we talk about residential real estate in the United States, that is a $2 trillion industry. If they can even capture 1-2% of that, we're talking revenues that are multiples above where the company is at right now. And this is part of the reason why Eric Jackson is so bullish on this company based off of the fundamental data that he's analyzed. He believes that they are strategically positioned to get some of that market share. I mean, we look at companies like Zillow that tried getting into the iBuyer space, and it didn't work out, right? They dropped out. But Opendoor did not. They have no competition when it comes to the iBuyer space and real estate. And, to their credit, they did not abandon it. They stuck with their plan. However, they have adjusted as we've seen mortgage rates skyrocket over the past couple years. They were able to tread water, and now they are strategically positioned as we get into a more favorable real estate market, as mortgage rates kind of stabilize, begin to drop, as we anticipate Fed rate cuts. They're basically in a position now where they can really make some leaps and bounds in this space. So very excited to see what happens here. And as far as the retail interest on this, checking apewisdom.io just to see trending stocks on Reddit in the past 24 hours. Opendoor, last week at certain points was right around, 10, 12. It was starting to drop where it was ranked number one, a couple of weeks ago, and it is climbing back up. It is currently in the top 5 as far as trending stocks on Reddit in the past 24 hours. So that tells me the retail frenzy is still attached to this company, right? And it's really a good signal that the momentum is in fact not dying. There are still eyes on this. There's still people watching this. And the timing couldn't be better given the fact that we have earnings coming up, right? So that's a little bit on basically where we stand with earnings and basically where we stand with that renewed interest from the retail community, still sticking around from that initial run up we had a couple Mondays ago. So now, moving into some of the ownership in the company, right? We've highlighted on the show in previous episodes the fact that Opendoor, unlike some previous meme stocks, has significant institutional ownership. We're talking upwards of 50-60%, depending upon what sites you're actually looking at. Market Beat had it listed right around 62%, Fintel right around 50%, right? And so there's a lot of institutional ownership in the company. Some of the most notable large ones being Vanguard Group, BlackRock, right? Those are a couple of them. BlackRock is well known for buying up real estate like no one's business. And we had some interesting filings via sec.gov related to 2 of the largest holders in the company at an institutional level. So I wanted to cover that because you may not be aware of this. First of all, Vanguard Group sold about 20% of their position in Opendoor, right? And I know what you're thinking when you see that. Oh, shoot, they don't believe in this company anymore. I don't really look at it like that. I look at it as them basically trimming some of their profits, right? Which is something any good trader would do. They still hold a significant stake. They went from over 86 million shares down to just over 66 million shares, right? So they did drop some shares into the market. They sold. Now, another one that is very interesting is BlackRock. BlackRock sold off a major portion of their Opendoor holdings. They went from over 47 million shares down to just over 12 million. They basically went from about 6% ownership in the company to about 1%. Why did they do that? Your guess is as good as mine. Every institution has their own reasons, but clearly they're not as bullish on the company as they once were. So I thought that was significant. And then you got Context Capital Management that also came out with a filing. They completely wiped out their entire position as well, which is just over 44 million shares, right? So just a quick breakdown on that, right? So this is all via Fintel. So you got these 13G filings. Vanguard Group ownership fell from 12% to 9%. BlackRock went from 6.5% to 1.7%. Context Capital sold off everything. And you can see the dates for, when these filings were reported to the SEC. Vanguard, July 29th, BlackRock, the 17th, Context Capital, the 14th, right? And so in total, what you're looking at here is just a hair under 100 million shares that were sold in less than a month, right? Now, beyond the fact that we had an insane run up to $5 and that momentum realistically can't be sustained, we definitely needed to cool off. If we look at the RSI, the relative strength index, it was up to 95. That thing was way too hot. Definitely needed to cool off, right? Beyond that, the fact that you have these SEC filings that came out that, a lot of people beyond just myself have been paying attention to could have easily added to some of the selling pressure that we have seen over the past, week and a half, really since that Monday run up. The fact that you have almost 100 million shares dumped into the market is pretty significant, considering their entire float is something like 700 million. So I just thought that was interesting. And just as a key reference point, these were all 13G filings. So quick rundown on some of the different SEC ownership filings you might see. If you're not aware, a Schedule 13D is basically any investor that's acquiring greater than 5% of the company active ownership, right? They want to change things. A 13G is a passive investor, which is what Vanguard, BlackRock, Context Capital, that's the kind of positions they had in Opendoor. They're not looking to change things. They're just taking a passive investment in the company. And then you have a Form 13F, which is all institutional managers with greater than $100 million in assets under management. So why do I share this? Very simply, the 13G filings, they have to do that within 10 days. So we can know for certain that within 10 days of these reported SEC filings, these companies sold, right? So and the reason I point that out is because somebody might look at these numbers and say, oh, they sold that amount on that date. And that's not accurate, right? They have within 10 days to put out their filings. So yeah, that's kind of bearish news, right? That we have over almost 100 million shares that got dumped from some of the largest institutional investors in Opendoor. But with that being said, I think it's still significant that Vanguard is still holding a good chunk of their portion in the company. And if we take a look down here on Fentel, these are some of the 13F filings. So these are, some of the major buys that we've seen over, the past couple weeks. So we see here, Jennison Associates bought up over 500,000 shares. Y-Intercept, Hong Kong Ltd, bought up almost, 500,000 shares as well. You got some other notable ones here as well. You got PGIM, Jennison Blend Fund. They bought up over 500,000 shares back on July 29th. So it's not to say that everyone's selling at the institutional level. You definitely still have buyers. And you got to keep in mind, when you're sitting at over half the float being held by institutions, you are going to have competing narratives. You're going to have institutions that believe, you're going to have institutions that don't, and end up selling. You have bullish and bearish narratives that are constantly being cross-checked and reevaluated. And that's why we see some of these, filings coming out. So just wanted to make you aware of that in case, you weren't aware of it. But all that to say, I'm still very bullish on Opendoor. I think we have an exciting week ahead of us with earnings coming out. We will, of course, be continuing to follow up on that. And, when we come back for the midweek check-in on Thursday morning, we will, of course, be breaking down how that earnings report looked for Opendoor. And now let's move on to some of the more macro news that we saw this past week. Let's just kind of lead off with what we saw on Friday. So as I mentioned at the beginning with Opendoor, there was a key economic data point that came out on Friday that was bullish for, Opendoor, but as far as the overall market, it was bearish. And that, folks, was the jobs report. So this, according to NBC News, the U.S. job market was weak in July and previous months were worse than thought. Sharp revisions of government data show the U.S. created just 33,000 jobs total in May and June, while July's numbers came in soft too. So this is not great. It's starting to show cracks in the labor market. And, we did see the unemployment rate in July was essentially unchanged at 4.2%, but more people left the labor force. According to the report, payrolls have now averaged just 35,000 over the last 3 months, the weakest pace of job growth since the onset of the pandemic in 2020. So this is not fantastic. And as you can tell here from my S&P 500 chart, we had a very big sell-off that's really, happened over the past couple days between Thursday and Friday of last week. But, Friday in particular, we saw a big dump due to basically that economic data point. And so what you're also seeing at a macro level is that bond yields are starting to tank, especially the 2-year, which is what the Fed pays attention to the most. It's basically what they use to track their overnight lending Fed rate, and they're basically trying to keep up with that, right? And so we saw the 2-year bond yield drop significantly on Friday due to this data point, basically meaning you have a lot of people that are, flocking to buy bonds, right? And looking to get into a more, risk-off positioning due to this poor labor data that came out. So that was the weak jobs report that we got on Friday. And basically the way it affected our September rate cut, and this is what I believe affected Opendoor in a positive way, is the fact that we are now up to over 80% chance of a 25 basis point cut in September. This is pretty wild. If you have been paying attention to this, again, this is cmegroup.com. Anyone can look it up. But the fact that we went from, a month ago, 64%, a week ago, 61% chance of that rate cut happening in September. And then we had the Fed rate decision last Wednesday. And based off that, after that, the odds of a rate cut dropped significantly down to about 48%. But as soon as this economic data came out on Friday, we jumped all the way up to 80%. So as of right now, an 80% chance that we are going to get that cut coming in September. And again, this is significant for Opendoor because they are in the housing market. They're in the real estate market. Rate cuts are good for Opendoor because it makes mortgages more affordable and really helps to stabilize and get going again the housing market in general. So that's what dropped on Friday as far as some of the economic data. Again, fewer jobs than expected, not great. And honestly, Jerome Powell was really just in a bad position, in my opinion. Having that Fed rate decision 2 days before this number came out really didn't help him. I'm sure if he saw this, he would have been a bit more dovish on that September cut when he had his FOMC statement. He maybe, call me crazy, but he maybe even would have considered a rate cut in July had he seen this data prior. So we don't know, of course, but that's what we're looking at now for September. Again, 80% chance of a rate cut, driven largely due to this U.S. job market data that came out that was not too great on Friday. And, one of the individuals who really didn't like that data coming out was President Trump. This, according to CNBC, the revisions are hard evidence. White House struggles to justify firing of Bureau of Labor Statistics chief over weak jobs numbers. So if you didn't know, now you know. President Trump did fire the Bureau of Labor Statistics chief over those weak job numbers that came out on Friday. He definitely was not happy with it. And, individuals on both sides of the aisle have kind of been questioning this as well. Trump on Friday fired Megan Tarfer, accusing her of manipulating the jobs numbers for political purposes after the latest report included downward revisions to job growth data for previous months. So, Trump obviously wasn't happy with the data. Look, I'm not going to get political here. This is a market show. So, drop a comment. Let me know what you think about this, if this was a bit premature or if it was justified. But he's looking to replace the Bureau of Labor Statistics chief after those numbers came out. Him and, his administration were obviously not happy with those numbers. I would venture to say, though, my own 2 cents here, numbers don't lie. I don't know if there's hard evidence suggesting that, she manipulated the numbers. I guess if that comes out, then we'll have to revise that statement. But as of right now, the numbers are what they are, and they don't look too great. And that's, again, part of the reason why we're looking at an increased chance of a rate cut coming in September. So let's do a quick overview of how the markets looked on Friday in light of that economic data. This, according to CNBC, Dow closes 500 points lower Friday as weak jobs data and new tariffs incite sell off. So again, taking a look at the S&P 500, we're now below the 20-day moving average as of Friday. And, past couple days, Thursday and Friday in particular, were not great for the market. The RSI on the S&P 500, however, has had a chance to cool off in a rather dramatic fashion. It's currently sitting at 47 after it was as high as 76, which is pretty intense on an RSI scale for the overall market, the S&P 500. So it is good in a sense that we've had, some time to kind of reset. We'll see if we can kind of stabilize. Really, the next psychological level I'm looking at on the S&P would be that 6,200 psychological level. We'll see if we can hold that. And then below that, you're basically looking at closer to 6,000, 6,041, basically where resistance was back in early June. I think that would be support as well if we are unable to, hold 6,200. So we'll see what happens there. Quick check-in on the tech-heavy Nasdaq via the Qs, and pretty much the same story. Tech got hit pretty hard as well, and the RSI on that currently sitting at 48. So still a little bit hotter than the overall S&P, which makes sense. Tech's been on a tear of late, but it is starting to cool off a little bit there as well. And support for the Qs, I'd be looking at 535 as next resistance. We'll see if we need that. Hopefully we can catch a bid on Monday or Tuesday and try to reclaim the 20-day moving average, since the Qs are now also below that as well. Quick check-in on the Russell 2000 via IWM, and this one crossed below the 200-day moving average on Friday, so that's pretty significant. We had this kind of consolidation period over the past couple weeks once we had gotten above the 200-day moving average, and as you can tell, small caps have been struggling over the past week, and now we're back below the 200-day, although we did have this nice wick back up, so an attempt by the bulls to push it back above that 200-day moving average. We'll see where we land on Monday and see if we can reclaim that. And then the VIX, if anyone bought VIX calls earlier this past week, you were sitting pretty. As of Friday, we got a massive jump on the VIX. I think at one point it was up something like 15%. And basically we're now sitting back above 20, which is a spot we haven't been in since end of June. So the VIX closed at 20.38. It is above the 200-day moving average. And basically the fear gauge on the market right now is, showing signs that there is some uncertainty, again, due to that economic data we got on Friday and also the tariffs, because keep in mind, President Trump and his administration have slapped, tariffs on countries as of the end of last week, now that that pause on those reciprocal tariffs has lifted. And so you got some uncertainty and fear creeping back into the market because of that. And that's why we see the VIX now getting back above 20. In my opinion, if you're an active trader, it's actually not a bad spot to be in because you have elevated volatility, which makes it easier to, spot certain breakouts, trends, things like that. So that's where we sit right now on the VIX. And as far as key economic data that is coming out this week, kind of light, but also not light. Definitely not as crazy as we saw last week, but we still have some key reports coming out, most notably some inflation reports, right? We're going to get CPI coming out on Tuesday, August 12th. That's going to be at 8:30 a.m. Eastern. And then PPI comes out at 8:30 a.m. Eastern on Thursday, August 14th. And then Friday, August 15th, we're going to get a good look at the consumer from core retail sales. And then also retail sales, just in general. You're going to get core, which is month over month for July, and then month over month for for July as well. Those are both coming out at 8:30 a.m. Eastern on Friday. So that's what we got for key economic data for the week ahead. And then as far as earnings that are coming up this week, some of the more notable ones, we're going to get Palantir reporting on Monday. You're also going to get Wayfair on Tuesday. We're going to get AMD and Pfizer, Caterpillar, Rivian. Wednesday, you got Disney. That's a big one. McDonald's, Uber. On Thursday, you're going to get Eli Lilly. And then on Friday, for all my AMC fans, looks like you got AMC earnings, Wendy's, Under Armour. So nothing too crazy. I'd say the big ones there are going to be Palantir, AMD, Pfizer, and then Disney, right? Those are going to be the big notable earnings. If you are an earnings trader, to definitely be paying attention to as we head into the new week. So that's what we got as far as a jam-packed market prep episode for this week ahead. I'm very excited to see what happens with Opendoor. We got the earnings coming up. Make sure to be paying attention to that. Make sure to drop a comment. Let me know what your thoughts are on Opendoor. Let me know what your thoughts are on the firing of the chief for the Bureau of Labor Statistics. Is it justified? Is it not? We'll see what happens this week ahead. Definitely appreciate all the support that we've been getting on this channel. We will be back as always Thursday, 8 a.m. sharp for the market midweek check-in. Make sure to like, subscribe, share with a friend, follow wherever you listen to podcasts. And folks, as always, remember, plan the trade and trade the plan. Have a good one.